right, so I'll talk to you a little bit more about just a couple of questions that came up about exam content, and I'll get to that at the end. But it's clearly the indirect method cash flow statement only, receivables and factoring of receivables and bad debt balance. Yet, I will answer all the questions. But for now, I'm going to go back and finish 10. We're going to start 11 today, so just make sure we're on that module. It's 10.7. And on page 4, we're now going to look at the retail method. Now, just to kind of refresh your memory where we are, the focus of this part of the chapter is to determine any inventory on an estimated basis. You need an estimating of any inventory if you cannot count it or if it's not practical to count it. So let's say if you're doing a weekly or monthly inventory, you may not want to do a full inventory, so you estimate it. If inventory is damaged, if you want to test for spoilage, if you want to test for any theft or any other improprieties on the inventory, you would use estimating techniques. We already looked at the gross profit method, and this is known as the retail method. This is also permitted under IFRS. Retail methods are permitted for not only internal but also external reporting. They can be used for annual reports as well as interim. The gross profit method cannot be used for external reporting. Now, the premise is really the same. You're going to work with the relationship between cost and selling price to estimate any inventory. You're also going to be, in this case, required to have dual records. You have to have records on both cost and retail. Now, when you have a retail operation, you generally mark up and mark down your product. So let me just tell you, we'll see the term net markups, net markdowns. Let me try to explain what they are. When you look at a markup or a markdown, it is in relationship to the original selling price. So on page 7, on page 4 rather, with module 7, you'll notice that if I have an item that I buy for 15 and my original selling price is 30, well, you might say there's a markup of 15 there. We're not going to worry about that. The terminology that we're using is whether or not you change the original selling price. So have you modified the original retail price? If that retail price goes up, that's called a markup. If you reduce the retail price but not below the original selling price, it's not called a markdown, but it's called a markup cancellation. So markup cancellation is not the same as a markdown. A markup cancellation reduces the selling price but not below the original amount. So the original amount is 30, and then you mark it up 5, then you mark it down 3. So the net price, the net markup is 2 in this case. The net markup is 2. On the markdown end, we start with a cost of 15, then our original selling price is 30, then we have to reduce the price to 23. That's called a markdown of 7. Now, if I ever increase the price again, but if I don't go below the original selling price, it is, or I should say, if we mark it up again but don't go above the original selling price, it's not a markup, but it's a markdown cancellation. So what you would do is take markdowns minus the markdown cancellation to get the net markup. And that's the number we need in retail. So we start with the selling price. We do not base it on the original cost and then that original increase. Now, just one other thing to do, and I will tell you that, yes, markups and markdowns are a critical piece of this. We will add them to the retail column. There are some other issues that you have to be aware of. I'm not going to ask you to do all of these, but just remember from basics of accounting that freight in gets added to the cost of inventory. Purchase returns and allowances, purchase discounts also get reduced from the cost of inventory. And from the retail side, if you do return a sale, you also have to reduce it on the retail end of it, if you ever see that. So we're not going to really work too much of the sophistication here with shortages. This is really here for your reference. Now, what we're going to do is do a series of problems that are important for us to not only know, but understanding the retail method. So we're going to start off with a company that will provide you the following information for 2017. So we've got the beginning inventory at both cost and retail. So you have to keep dual records. And I'm going to write this on the board so we can refer back to it. So we're going to have dual records at both cost and retail. And we have the beginning inventory. And at cost, it's 18. And at retail, it was 30. And then we've got purchases. And those purchases are 82 at cost. But at selling prices, they're 120. We also then have additional markups, and we have markup cancellations. So we're going to use the net markup. Now, markups only apply to the retail side. They don't apply to cost. And on the markdown side, we've got markups are 10, markup cancellations, markdowns are 12, and markdown cancellations are 2. So we have the net markdown, right? And the net markdown is 10. That's fine. That's what it is. Oh, yes. So, when we look at the information, we've got beginning inventory purchases, net markup of 5. 5 minus coming out of 10, and net markup and sales 100. Sales 100. So that's the basic stuff. Now, we are going to look at the retail method as a way to emulate or mimic actual cost flow. So the first one we're going to do is average cost. So what we're looking at right now is the average cost method. We call it the average cost because it averages everything into the cost to retail ratio. The cost to retail ratio is designed to deflate the ending inventory at selling prices. So what's going to happen is that we're going to get a goods available for sale at retail. So we're always going to get a goods available for sale at retail. And if these are sales, now we're going to assume that 45, and I have this in notes as well, is the ending inventory of retail. Now the premise is to get this at cost. How do I get it at cost? I have to have some type of cost percentage to multiply against that. So I'm going to need to find out what percentage of that ending inventory at selling prices relates to cost. Now, when we did the gross profit method, what did we use? We used the cost of goods sold percentage. This time, we're not going to do that. We're going to use something known as the cost to retail ratio. So it's the cost to retail ratio. The cost to retail ratio is the only difference that you're going to see in every one of these methods. So if you've got 5 different retail methods, the only difference is the cost to retail ratio. The retail ending inventory is not going to change. It's always going to be at 45. So, although not on this test, but I can ask you in one question, I want all 5 methods. If you keep writing out each one, you'll never finish. all you need to know is, once I get the 45 here, what's the cost to retail ratio that I'm going to use to deflate that 45 to cost. So let me show you. Average cost includes everything in the cost to retail ratio. It averages in beginning inventory, purchases, markups, and markdowns. So everything's included, and the cost to retail ratio in this case is 68.97. It is the ratio of goods available for sale at cost, which you see here. It's going to change a little bit from method to method, but cost to retail, and we're looking at the amount available. Divide that by the retail available, it gives you a ratio of 68.97. So average cost averages in beginning inventory, current purchases, markups, markdowns. Ratio, goods available for sale at cost divided by goods available for retail, 68.97, and you get the ending inventory at cost at 31,037. 31,037, and that is the ending inventory at cost. So very much like the gross profit method, you get a cost ratio that you use to deflate selling prices. And this is the cost of inventory. So let me repeat the process. You keep records of both cost and retail. You would look at the average cost, let's say first, in the average cost method. You've got everything averaged into that ratio. Beginning inventory, purchases, markups, markdowns, and that would give you the cost to retail ratio. The ending inventory at retail is always the same. Goods available at retail minus the amount you sold is the ending inventory at retail. That number won't change. What will change on each one is going to be the way we deflate that selling price down to cost. Now, to make this realistic before I summarize, let's take the next one and then we'll take some questions. What about conventional retail or lower of cost or market? The conventional retail or lower of cost or market. So just remember, conventional and LCM are the same. This method will only include markups but not markdowns in the cost to retail ratio. And by including only markups and not markdowns, so what will happen in this case, you're only going to include the markups and not the markdowns. So what's going to happen? By only including markups in the denominator of the ratio, it makes the ratio what? Lower, and therefore getting closer to an LCM. So when we look at the ratio itself, it's going to be beginning inventory plus purchases, markups only, and that's when we take the ratio. So LCM includes markups but not markdowns in the ratio. That makes the ratio more conservative. It went from around 69% to 65%. Then markdowns are treated like obsolete inventory or a write-down of inventory. So notice what happens. You're going to still get the 45,000, and this is always going to be the same, right? It's not the ending inventory of retail that changes, but it's the ratio. It's the ratio. So now the ratio is at lower of cost or market, and when we deflate that, 45,000, you now have inventory at LCM 29,034. Now we'll take some questions. Let's think about the procedure. The idea is to estimate inventory. You've got goods available for sale at both cost and retail. If I take retail available for sale and subtract out the sales, I get ending inventory. It's the same thing. It's really the cost of goods sold formula using selling prices. Right? Beginning inventory plus purchases gives you goods available, minus what you sold gives you what is left, except that it's at selling price. So that 45,000 is not going to change. What will change is the ratio. So average cost puts everything into the ratio. LCM conventional will only include markups and not markdowns. By markups in the denominator or that fraction, it makes the ratio smaller. And therefore, you get a more conservative estimate. So let's take some questions now on this approach so far. And really the rest of the presentation is going to really revolve around changing the ratio. There's a couple of things that are going to happen. With LIFO, you'll see, or dollar value LIFO, but any questions on the first two approaches? Yeah. In this case, it means that by lowering the percentage, you've got a lower value of inventory. So it's a more conservative value. More conservative value. So let me start to summarize this with you. And I will tell you that you would see the difference. And I'll type this out for you and post it to Blackboard. I usually have it on in my notes. I don't know why I left this off. So if you wanted to start to get a summary, I would say, what's the method? Well, average cost. What's the cost to retail ratio? All costs are included. Current, prior, that's beginning, markup, and markdown. So prior cost or the beginning. The ending inventory was 31,037. The LCM conventional ratio only includes current, purchases, beginning inventory, and markups, not markdowns. Markdowns are treated as a write-off. So again, current, purchases, prior, beginning inventory, markups, not markdowns, and the markdowns are treated as a one-time write-off. And notice it becomes more conservative, right? It lowers the inventory value. So those are the first two approaches. Yeah.
The average method.
Yeah.
What's the 145,000?
That's the well, that's the calculation of what goes into the cost to retail ratio. So that's like the goods available for sale, and you'll always get goods available at 145 at some point. So on the average cost, it happens to be here. Under the conventional, this is the goods available, but it's after the write-down. So it's really not going to change the goods available. What it will change is the point at which you calculate the ratio. So put that back on the screen. So what I'm saying is that I thought I had this on the screen, so I'm going to answer the question again. When you did the average cost, goods available for sale, and the point of ratio calculation are the same. When you went to the LCM, the ratio is calculated here at this point, but the goods available does not change. It's got to be the same. Any other questions on average cost, LCM convention? Let's try another one. What do you know about the FIFO method? Under the FIFO method, the first goods in are the first ones out. Under the FIFO retail, which is not in the book, but I'm just putting this in here to be complete, it will indicate that all beginning inventory is probably sold first. So therefore, what's the most relevant information to put in the ratio? Current cost. So what FIFO does in the ratio, it excludes the beginning inventory. So it only includes current costs. And if that explanation doesn't resonate, think of what you know about FIFO. FIFO is current or replacement cost, so therefore your ratio should only include current costs. So the ratio only includes the current cost, and therefore the ratio in this case is 71.3. So it's much higher. And again, after the ratio is calculated, once again, the only difference in all these methods is the point at which the ratio is calculated. So everything else will remain the same. The ratio is calculated here at 71.3. Retail ending inventory does not change, and when we deflate that, we get the FIFO cost at 32.85. So the idea of FIFO is current cost only, so the ratio excludes the beginning inventory. Logic, LIFO is only current cost. Or if you don't like that one, the logic is first goods in and the first ones out, so ending inventory should be in the current purchases, assuming the beginning inventory is all sold. Now again, this is only an estimate. And once again, if we go back to the summary, the FIFO method, the cost of retail only includes current cost, which is the purchases, markups, and markdowns. So it only includes your purchases, markups, and markdowns. And notice it's 32.85, and it's the highest value, as you would expect. So the first three methods are, I think, relatively easy to calculate. You're just going to remember what goes into the ratio. When you get to LIFO, things get a bit different because LIFO requires what? Layers of inventory. So you have to separate out beginning layers from current layers. So you're going to have to take the ratio at different points. You're also going to have to think about increments in those layers. So, for example, we know that if you look at the beginning inventory and the ending inventory at retail, there's an increment of 15,000. And how do you price that increment? Well, that's the issue with respect to LIFO. All right, so we're going to get to that right now. Are there any questions on the first three? Anything on the first three? All right, so let's go to the LIFO basis. This is exercise 4 on page 9. And we have to separate out each layer and price the layers accordingly. The layers will be beginning inventory plus the increment or minus the decrement. So when we look at LIFO, when we look at the LIFO retail, it's got the same logic. You're going to have to look at the beginning, layer, and the current. And that current layer will be an increment or a decrement. Increment or decrement. Now, this is before we even get to the actual problem. If you look over on the 4 board, you're going to see that the beginning layer has to be 30 in this case. Is our retail. if the ending inventory is 45, then that layer has to be 15. And there's an increment in this case of 15. And that's what we're going to price out. So we have to price each layer separate, right? Each layer has a separate price. So let's see how we do that. All right, so the first layer is the beginning inventory. And what's the price associated with that? Well, in this case, it's the cost associated with that. So if we go now to page 9, and this is LIFO retail, not dollar value, so it assumes stable prices, no price index here. The cost to retail ratio only includes the beginning inventory. So it's really at this point. Right, so it's the 30, 18 divided by 30, it's going to be 60%. So that's the pricing we need, or the cost that we need for that first layer. The cost of the first layer is 0.6 or 60%. The next layer is going to be current cost only. So the current pool for the current layer is going to be the FIFO costs, right? Same prices for the current year. It's 71.3. So when we need to value, and the increment is 15, right? So when we need to value out that inventory, we're going to price them out at the pricing here is going to be at, and I'll show you on the screen in a second, but the pricing here is going to be at 60%, and for the current layer, it's 71.3. That's what you would use to deflate basically down to cost. So to put this up on the screen for you, you're going to see that the beginning layer, now that's obvious, you know, on the exam, you really have to show this, but you know that if you have 30,000 in retail, you're in that first layer. In this case, it's simple because it's got, you know, only one line, it's 18, so you don't really have to do that. But just remember, I'll show you, but just remember that next year, this becomes the beginning layer. And it's got 2 layers embedded. So you just can't assume that it's going to be what you see up there for beginning inventory. Beginning inventory may be broken out into layers. So what you have is base layer at 0.6, the increment 0.713, 10,695. So the ending inventory at LIFO retail is 28,695. Now make a note, if there's a decrement, it's got to come out at 0.6. So if inventory shrinks below 30, for example, what if the ending inventory was 20? It would come out at 0.6. Next year, if the inventory declines below 45, what happens? You take it out first at 0.713, and then you would take it out at 0.6. So it would be in the LIFO order. So once again, you have to think about how do I calculate the ratio. All the other numbers stay the same. And just the process is a little different with layers when you got LIFO. Yeah.
If you get more layers, it's purchasable.
Yeah, well, as long as inventory doesn't shrink. Yeah, same thing with straight up LIFO. If you keep buying units, if you buy more than you sell, you build up layers. And you notice when we did the liquidation case last week, LIFO liquidations occur when you sell more than you buy. I'm saying next year, in the beginning inventory, that, you know, if we were taking this problem, let's say it's a client, next year after the client, when you come into audit, their beginning inventory is made up of 2 layers. So what I'm saying to you is you just can't say, if I had it on the board, cost 28,695, retail 45, you just can't assume it's one layer. Because if you took that ratio, you'd get an average of the two layers. And that's what we don't want. We want you to have it precisely 71.3 or 60%. So that's the LIFO. So let me summarize that for you. So you can have a yeah.
If I had a decrement next year, I would list the beginning, the current, and then the decrement.
So if you had a decrement, if let's say next year's layer is less than 45, the first thing you do is you go into the 0.713 layer and reduce that. So let's say, let's say next year is 40,000. If it was 40,000, you take 5 out of here.
I would do like 30, 15, and then minus 5.
No, it's got to go here. It's got to come out in this order. It's LIFO order.
So I just do 30 and 10, 30 and 10.
Yeah, so it comes out, if you had, this was 40, it dropped by 10, so you'd have to take out, I'm sorry, this was 40, the new one, next year, drops by 5, 5 comes out of here at 0.713. If next year was, like 2,000 or something, you'd have to liquidate 15 and then 28,000 at 0.6. So it's got to be in LIFO order when they come out.
So I'll only report the leftover.
Yeah, and it's got to be last in, first out.
Will we always be giving those ratios, except for the current year?
Yes, so in other words, in the event that you were given a beginning inventory, you'd have to know what the layers were.
Okay.
All right, good questions. Any others on this? Now, to summarize one more time, just to show you where we're going with this. Now you've got LIFO and stable prices. And the ratios, you have two ratios. You have a base layer ratio and a current layer, and then you have to get the increment or decrement. That's the key. And in this case, it comes out to 28,695, and you would expect LIFO generally to have the lowest cost. Notice that the relationships are very much like what you get with actual LIFO, FIFO, and average. I'm not going to worry about the LCM right now, but just look at the rankings in here. Highest inventory is FIFO. Lowest inventory is LIFO. Average cost falls where? In between, which you would expect. So this is, although it's an estimate, these approaches are very indicative of what they would have been had you had the actual numbers. So it's doing what it's supposed to do. Anything on LIFO? One more to go. It's going to be very similar, except that we're now going to go to dollar value LIFO retail. So we're going to bring in inflation and the price increase. Who's LIFO stable prices? So let's go to the next one. Turn to the last example, which is exercise 5. On page 10. And I'm going to bring it up on the screen in a second. All right, so this is dollar value LIFO retail. We're assuming now that the beginning inventory was the base year, so the price index is 100. And the current year's index is 110. So, in putting this in steps, which I know a lot of people like to do, you got to get the ending inventory at current prices, and you got to convert that to base year. Get the ending inventory, convert it to base year, get the increment or decrement in base year prices, and then you'll wind up converting that back to current year and then to cost. So there's an extra step. The extra step is that base layer and current layer have to be deflated to base year prices. Once we do that, we get the increment or decrement in base year prices, and then the process is pretty much the same. So let's see how that would work. The first thing you do is get the ratio, which we've already done with the other example, for the beginning year. And then we get the ratio for the current period, which is going to be the 71.3. We also know the goods available, 145. We know the sales are 100. We know that beginning inventory at retail doesn't change. And that's why I said if you were doing a problem with multiple parts, this number is never going to change. So if you sit there making up these schedules, it's kind of a waste of time because this number's not going to change. As long as I don't change anything else in the problem. But let's see what we need to do. I now have a base layer, an ending inventory, and a beginning inventory. So I've got to get the increment at base year prices. So I've got this 30,000 and 45,000 at current prices. I've got to bring them to base year. So your goal is to get the increment or decrement at base year prices. And that actually has to be looked over. So I guess this isn't translated very well in printing, but this should be somewhere here. Yes, it's really right there. Okay. So this calculation is the primary difference in the two approaches. So what we want to do is take the ending inventory, which is at a current price, and we need to deflate that to the base year, and of course the beginning inventory is in the base year. So the increment in this case is 10,909. That is at base year prices. So the only other step is right here. So what you need to do is to take retail at base year, then you have your price index, and what you don't see here, I'm going to put right up here for you, is the result. So probably should have added a column, but the result there is this is now retail at current. So what you do is you take the retail at base year, 30,000, multiplied by the index of 1. That gives you 30,000 of retail at current prices. The increment is 10,909. The price index is 1.1. The current year retail is 12. These numbers are now at retail, and then the rest is the same. To make them at, I'm going to write this again in a different way. To make this at cost, you hit the index, you hit the ratio at 0.6, and to get the increment at cost, use a ratio of 0.713. So here, what really happens, and let me just clear this out a little bit more, and see if I can put this into a different, format, make it a little cleaner. So now if you have dollar value, LIFO retail, you've got the beginning labor at 30, then you have the 10,909, and you have the ending at 40,909. This represents retail inventory at base year. base year prices. So the index is used to get retail at current year prices and you don't really need a total here, but it's 42. And then you have the cost to retail ratio. And the dollar value. So that's the 18. And that's going to be 8. So the only step, the extra step is here. You had to get the beginning inventory increment at the base year price. And by the way, the difference between regular LIFO and dollar value LIFO retail is going to be the effect of inflation. So before, if you took regular color, so 28. So this is with inflation. Or I should say with stable prices. That's what inflation removed. This is regular LIFO. 28,695. So this is considered dollar value LIFO with stable prices. Taking out the effect of inflation, this includes inflation, and the difference is 2130. And that difference is all embedded in the current, in the increment, or current rate.
The difference is the inflation.
It's the effects of inflation, yeah, because dollar value LIFO controls for price changes. So the dollar value is 26,556, where straight LIFO, stable prices, 28. I should say. This actually removes the effect of inflation. So this would assume, this removes the inflation, this is the assumed stable prices. The regular. This includes the index with the inflation. And the difference is the impact of inflation. So the dollar value LIFO theoretically is the real value. This includes some of the inflation that's in the current. All right, so we're going to try a couple of questions in a second. First, let me summarize this for you. So the last one is dollar value LIFO. Once again, base layer, current layer, same increment or decrement, but you must compute them at base year prices, and that 26 removes the effect of inflation from the current rate. That's why it's there. So that takes us through all of the retail. I'm going to ask a couple questions on the back of the modules in a second. again, dollar value LIFO adds that extra step. You have to have them at base year, then you inflate them again, or you bring them up to current year, and then you take out or get them from selling price to cost. All right, so if we don't have any other questions, I'll leave this up on the screen for a couple of seconds. Hopefully we've got everybody copied down. I want to do 3 questions in the back, 4, 5, and 6. The first one is gross profit, and the other 2 are LIFO. Retail, number 5 is a straight retail, and number 6 is a dollar value LIFO retail. I want to go first. Right. Anyone need a few more minutes on this? And the purpose of going through these 3 exercises to make sure you understand or have a good feel for gross profit versus retail. But I'm going to focus on the LIFO retail, the last 2, only because those are a bit more challenging, so I want to make sure we're covering. All right, so if we're almost there, ready? So let's go back to the module. If you turn to page 13. All right, so we'll put that back on the screen. Any other questions on what's up there right now? All right, so let's go to question 4. And this is going to ask you for the gross profit method. It's a perfect example of why you would use it. Fire is destroyed, cannot be counted. You have an insurance estimate that you have to provide on the value of the inventory. So let me give you 3 minutes on this one. It's the gross profit method, the first one we did in the estimation. So we've got page 13. It's the gross profit method, estimating inventory on August 31st, 2017. And okay, so you've got half the class with B in that. I think is the right answer. I'm sorry, A rather is the right answer. So the upper class is B. Now, did I do something wrong? Let's see. Since half the class has B, I got to double check my calculation. So let's see. So it's larger. So here's what I did. At the beginning of the inventory, let's see if I added it wrong, so I couldn't have a mistake doing this. I do all these myself. See, I got beginning inventory at 500. I got purchases of 9, and I got freight of 30. So I got goods available for sale at 1430. And then if I sold 2 million and my gross profit margin is 40, then the cost percentage is 60. So then it's got to be 1.2. And 230 is my estimated inventory. Now, let me just check the answer to B. Because the answer to B is probably, let me just see if I can double check that. So let me see what you did. Okay. Yeah, so what you did was take, so if you picked B, then you got 0.4. Which is the gross profit on that, and that would be, you want the estimated cost of goods sold, not the estimated gross profit. So the answer is actually A, it's 230. All right, so any questions on that? So you have to take sales at the cost percentage. How else could you have done that? How else could you have handled that one? You could have taken sales minus the 800,000, take the profit out to get the cost. All right, any other questions on this one? Number 5. Want to know what is the correct combination of ratios to use in the LIFO retail method. So this one is just a matter of ratio calculation. So we can do this in 2 minutes. All right, so yeah, so A would be correct. So let's just see why. Let's get this over the screen. There we go. So it would be, as you see, the beginning inventory at cost is 20, retail is 40, it's 50%. Purchases 80 at cost, 100 at retail, markups 5, markdowns have to be 5, so that zeros out. Goods available are 80 at cost, 100 at retail, so that's 80%. So the correct combination is going to be 50% beginning layer, and 80% for current. And the ending inventory, and sales were 60. We didn't need that. All right, so any questions on this one? Okay, the last one I want you to do is a full problem. You've got to come up with the dollar value of LIFO, number 6. So let's make sure we can do this and then move ahead. All right, so I'll start the clock on this one. And this one's at least 3 minutes. So, actually, for those of you that did, you got it right. So B is the answer. So let's see how we can get that. I'm going to move this out of the way. Second. All right, so first, how'd you get the ratios? Let's talk about that. How'd you get the ratio? The beginning ratio is what? 200 divided by 320. So you should have the ratio here of 62.5. Is that correct? All right. Then the next one, you got the purchases. 340, 400 divided by 460. That ratio should have been 74%, is that correct? Okay. Then if I needed to find out the ending inventory of retail, I know it's the goods available, which are here at 780. If I subtract out the sales, it's goods available. If I take the sales and subtract them out, then the inventory is 351. 351. So now you would just take that information and put that into from here, right? Let's take it. All right, the first thing we have to do, we know the base layer is 460, that we know. What's the increment in this case? Well, to get the increment, what you'd have to do is you would have to take the beginning inventory and add 320, divide that by the index, get the 320 back. And then the ending inventory was 351. Divide that by the index of 108, and that should have given you 325. So there's an increment of 5. It should be an increment of 5. And then once you have that, I'm sorry, the base year beginning United States 320. I'm sorry. All right, so beginning should have been 320. I just picked off the wrong number. But the purchases there instead. That's the increment of 5. So now we have to take those base year prices, begin them, get them to, or bring them to current year. Let's make sure it's 5. It is, it should be. I'm just going to check that. Yeah, it's 5,400. Okay. That should work. And the ratios then should be 625 and 0.747. So the answer should be B.